Its combined streaming services finally turned a profit. Shares of Disney are down 3% today after reporting weaker results for theme parks and citing signs of strain on the lower consumer demand and inflation. The company says it's likely to continue. Let's bring in Barton Crockett, senior media analyst at Rosenblatt Securities. Barton, it's good to see you. And there's a lot to unpack here. As you mentioned, there's kind of what's most important to Disney as a company and what's more interesting from broader sort of sign for the economy. What would you say we've learned?
Well, I think we've certainly learned, we've gotten one more data point supportive of this notion that there is some pressure on the consumer. The theme park segment for Disney is important. I mean, that was last year 70% of their segment profits. This year, I think pacing for around 2/3 of segment profits. So it's a key driver. And what Disney was saying last quarter is that they thought there'd be robust, as they put it, operating income growth in parks in the experiences segment that the parks drive. And now they're saying that segment's going to be down mid-single digits in profits here in the fourth quarter, and that those pressures will persist through the first 3 quarters of next year. And that's a really rapid, substantial change, and a lot of it is tied to the consumer domestically. I think mainly in Florida, weakening. We saw a little bit of that earlier with the Universal parks out of Comcast, and it's just been reiterated here with Disney. So that takes some of the luster off of the good trends they've had in, finally bringing their direct-to-consumer business into profitability.
So what is it that's happening here? Is it consumers just pulling back across the board? I mean, Disney has gotten the resorts are not a cheap ticket.
The resorts are not cheap, and and certainly with time we'll probably understand better. But we do seem to be going through a change, and we're just trying to understand what that change is. I think that one of the phrases that's been thrown out is that there's a post-COVID normalization, that people did a lot of travel and experiences, and now it's time to settle down and manage your budget, with a lot more inflationary kind of pressures. I think that the person who goes to a Disney theme park is probably tends towards above average, income and asset, kind of wealth, but not maybe as high as you would think. I think certainly for a lot of people, that's a generational rite of passage for your kids and your family. Disney has a line within their parks for cruise ships where they've been investing, really kind of delivering a very premium experience. That seems to be holding up stronger than the parks. And, maybe part of that is, who goes on cruise ships, but also there may be some economic differences in the clientele. But, clearly there's a change afoot, and we've got to start, understanding better what's going on.
I think of Disney as a place that is a special family trip, maybe not an annual family trip. Maybe if you're lucky, you can afford to go every year. But for many people, it's one of those things that you do maybe every 4 or 5 years. Let's talk about their sports segment. I was struck by the fact that ESPN's advertising revenue was up 17%. What was driving that?
So, people love sports. I mean, these guys, they had the good fortune of having the WNBA, and the whole Caitlin Clark thing has really transformed that. I think the sports are resilient on the pay TV bundle. Now, you're paying for that. They've got a new NBA deal coming up in a couple of years that they've inked, that's kind of jack up their programming costs a lot, and they've got to grow to kind of cover that. But that's why the athletes and the leagues are sitting in the catbird seat, because they are what advertisers want to get in front of. They're what people want to watch. They're the last kind of safe bastion of audience on TV, and they're getting paid for it.